Ladies and gentlemen, our next panel is all about the regulatory driver of change and some of the insights we've learned and opportunities for the future. If you recall, before we broke for lunch, we were talking about how various international centers appear relative to one another, but that, on a global basis, will now shift focus into the European time zone. Ladies and gentlemen, you may recall November 1st, 2007 was the launch of MiFID, the Markets in Financial Instruments Directive, trying to create a single market. Well, I'm going to prepare you for this next slide, which is a simple market map of what Europe looks like. Ta-da! So here we have a simple series of exchanges at the top, clearing in the middle, settlement down below. Now, those of you with eagle eyes will recognize the date at the top of this slide, April 2004. Those of you, also students of the market, will recall April 2004 was the date that the text of MiFID was released to us in the market. And one of the themes of MiFID, in addition to creating a harmonized single marketplace, was also the tool of competitive entry, with an expectation that with competition may come more choice and possibly fragmentation. And this is what Europe looks like 4 years later. If anything, more complex. However, do not be afraid, because with technology, we've been able to manage the complexity to give a better result. It's all in the context of the regulatory driver of MiFID, and this comes to our next panel, so may I welcome to the stage, from the European Commission, is Valerie in the room? Valerie? Fantastic. Valerie Ledure from the European Commission. Please come on stage. Thank you. Welcome. Thank you very much. Well, ladies and gentlemen, this is a rare and special opportunity to speak to one of the experts in the seat of authority spanning multiple countries in Europe. Valerie, MiFID, M-I-F-I-D. Some people think it stands for many investment firms find it difficult. But in fact, it has actually been a very significant change. Some say the biggest change to the regulatory framework in Europe since the Treaty of Rome in 1957. A lot of positive commentary around MiFID, but we're right now in the inflection point because we're about to have a new, updated version of MiFID, MiFID II. Valerie, could you share a few insights about the original objectives of MiFID and what you'd like to see as the next evolution? Thank you very much.
Thank you for the introduction. First, I would like indeed to give a few words on what MiFID I has achieved and why we need a review. MiFID I has proved reasonably successful in meeting its objectives, I would say. It has created more competition with the entry of new trading venues and enabled the reduction of trading cost, of transaction cost. In turn, this has led to more liquid, efficient, and efficient and better functioning European financial markets. But there have been some downsides, I would say. For example, the market fragmentation has made the functioning of these markets more complex, especially in terms of collecting trade data. New actors, such as broker crossing networks, have entered the scene while escaping regulation. So they found regulatory gaps, I would say. Trading competition has also been hindered or limited by the lack of competition in the post-trading space. Technological developments such as high-frequency trading have raised concern about market stability and integrity. And finally, I would say that the financial crisis has clearly demonstrated that the need to increase transparencies in less regulated markets like derivatives markets. This means that we have a MiFID II, which was adopted by the Commission in October 2011. Our proposals are currently negotiated with the European Parliament and the Council. I can come back on the timing later if someone is interested. But what we are really trying to achieve with MiFID II in terms of market structure is to move to more transparent and public markets. This means that all orders and quotes should first be made public so that all information is available to all investors, that all investors know what's going on in the market. Transparency should become the general rule, unless in well-justified cases, such as large-scale orders. So to a certain extent, we want to reverse the burden of the proof. Transparency is good unless in well-justified cases. How we are trying to achieve this? You probably have heard about this new acronym, OTF, the Organized Trading Facility. With this new, the introduction of this new category of trading venue, we want to ensure that all forms of organized trading providing for multilateral interaction is taking place on a level playing field with regulated markets and MTFs, and is taking place also in a fully transparent environment. Level playing field means the same rules should apply to OTFs and regulated markets and MTFs. This means that the same transparency rule will apply as well. This is why we have defined the trade transparency rules pre and post-trade by type of financial instruments, so that we are sure that irrespective of where the trading takes place, these transparency rules are the same. And then I would say the main distinctive feature between, on the one hand, an OTF and on the other hand, a regulated market and an MTF is the discretion the operator of the OTF can exercise. But because this operator can exercise discretion, it is also subject to strict conduct of business rules. And in order to ensure the neutrality of the operator of the OTF, we also prohibit him to trade on its own account against any orders submitted to the trading platform, to the OTF. It doesn't mean it cannot run a systematic internalization next to it, but the pools of liquidity have to be separate. Yes, so that's I hope a clear explanation on what the OTF is and its purpose. This means that any proprietary trading of an investment firm with its client will fall under the OTC or the systematic internalizer regime. The SI regime will draw the delineation between ad hoc OTC and systematic OTC. So if you look at the trading environment, you will have the three trading venues for multilateral trading, regulated markets, MTFs, OTFs. And in the OTC space, you would have the SI regime for systematic internalization, systematic OTC trading, and then pure OTC, which is ad hoc and irregular. A last word on the OTF. Another objective of the introduction of this OTF is also to ensure an alignment with the developments in the US around the mandatory trading of OTC derivatives. In the US, they've introduced the notion of a new type of trading venue as well, what they call the swap execution facility. And the OTF will enable us to have a close alignment between EU developments and US developments in relation to this G20 commitment, i.e. the mandatory trading of OTC standardized derivatives onto organized trading venue. In short, in a nutshell, I would say that all the above mentioned measures I've tried to describe will mean that only ad hoc irregular OTC trading will still be allowed to take place outside this regulated and transparent framework. That's it, a nutshell, the reforms we are trying to introduce in the market structure. And also maybe a quick word on the trade transparency side. Under MiFID I, we already had a trade transparency regime for equities markets. We are improving this, but I found that there are it's not a big change compared to MiFID I, the big change is with regard to non-equities markets, because there we are introducing for the first time a trade transparency regime for non-equities markets, i.e. bonds, structured products, and derivatives. And the last building block in this trade transparency regime is that we are trying to provide a solution for the emergence of a consolidated tape, and we are doing this by improving the quality and consistency of trade data, and also by providing an harmonized framework for the operation of a consolidated tape. And we still believe in a commercial solution in that regard. So the industry has still the opportunity to come with a credible solution, but we have a stick behind the door, if I may say, is that we have a review clause if within 2 years we still do not have a real and affordable EU consolidated tape, we'll go for a centralized solution and we will impose one single provider.
Valerie, thank you very much. At this stage, let me invite Michael Krogmann from Deutsche Börse Group to come to the stage. And while Michael is coming, Valerie, let me try and repeat to you, I think the message is transparency, transparency, transparency by various implementations. And ladies and gentlemen, on the screen ahead, you'll see a summary of text trying to break down the various market and individual member execution mechanisms. So broadly, brokers are able to be members of regulated markets and multilateral trading facilities. If a broker in the previous MiFID regime was using proprietary capital, they would register as a systematic internalizer. And what's interesting about broker crossing systems off the order book of exchanges, even if they're reported to the exchange, may be captured under the OTF framework. What's interesting today about many broker crossing metrics are two features. They tend to be selective and discretionary. So as brokers, we can determine just a selective subset of flow for broker crossing, but the discretion is very important. Whereas multilateral trading facilities and regulated market exchanges are non-discretionary, they just match, the broker determines how much, when, and where, and even whether an order will match or not. I think, Valerie, what you described about the OTF will be, it will have a flavor of discretion to allow brokers to continue to deliver best execution where discretion is needed. Is that correct?
Yes, but maybe a caveat to this. First, I mean, broker crossing networks will have to revise their business model in a significant way, I would say, because they will have to separate their multilateral trading activity from the bilateral or trading on account activity. And then the OTF category is there indeed to still allow for different business models to coexist, but we want the same rules to apply to a certain extent. This means that the discretion a broker crossing networks could exercise is constrained by the pre-trade transparency requirements that are the same irrespective of where the trading takes place. So it means there will be no discretion in terms of price. You have to make these prices public so that anyone can interact with these prices, and if there are better quotes, I would say.
And just as a question, will there still be pre-trade transparency waivers?
Yes. So that's the reverse of the burden of the proof. The general rule is transparency across the board, but of course there are cases where trading in the dark between brackets is still allowed and makes sense and is needed to preserve, the liquidity of the markets. And these waivers, they are in what we call the implementing legislation. So under the framework directive we are currently reviewing, we don't discuss which type of waiver should remain or should be amended. But that's maybe a debate we will need to have also, to a certain extent, under the framework directive to go to have more visibility on the implementing legislation.
Very good, thank you. Well, Michael, allow me to draw you into the conversation because as Deutsche Börse, the exchange group has a remarkable perspective because pre-MiFID, there's clearly a lot of fragmentation within Germany. And in a way, you're almost like trying to create a single market yourself. Could you share some insights, Michael, what Germany was like pre-MiFID and how that has changed from an exchange perspective post-MiFID? Thank you.
Sure. Thank you. Yes, first of all, for all the ones in the audience that expected Rainer Ries to be here, I'm sorry I have to replace him today. Michael Krogmann is my name. Rainer is traveling around, so I hope I can fit in. Thank you for the question, Robert. I think Germany kind of is a different animal when you compare it as a trading place, because in difference to all or most of the other countries within Europe, we never had a concentration rule in Germany, so we always had competition with 7 independent regional exchanges in Germany, which is actually given by the federal law in Germany that we still have so many exchanges which virtually trade the same set of instruments in their own order books. So when it comes to surveillance, for example, or finding the right price of liquidity, it was always the Frankfurt Stock Exchange, even before we introduced our fully electronic trading system, Xetra, that was determining the price. So the most liquid market always was Frankfurt, and all the other regional exchanges had to follow the price determination of the trading venue in all the respective instruments. Of course, when we implemented Xetra in '97, Xetra became the wholesale market, which has in German high liquid instruments, so in the German blue chips, for example, the DAX, has a market share of 95% within Germany, so clearly all the instruments and price fixings had to follow that one. Actually, the turnover that is taking place on the regional exchanges is mostly retail driven, because the market model is still a specialist model, which of course has different advantages and disadvantages compared to fully electronic trading. For example, in Germany, we start trading at 8 o'clock in the morning until 8 o'clock in the evening, have instrument scopes of 1 million instruments, including structured products, so that is kind of a different animal that needs to be addressed by various surveillance models, various market models, and of course various pricing and also post-trade models. Actually, the interesting part now that has been discussing on a European level also is the trading surveillance that we need to implement within Europe. Actually, that worked quite fine over the years in Germany when we had the price fixing of the same instruments on 8 different trading venues. Just due to the communication, our market surveillance office implemented with their colleagues from the other exchanges, because in Germany it is the case that we have for an exchange you need to have a private and public law setup. So actually all the surveillance is taking place in the public law setup of the exchange, so they are independent from us as the operator, as Deutsche Börse AG. So they are able then to implement certain reporting lines and certain things that happen in the order book, and just to align and coordinate these things and check whether there is something wrong with the trading.
Well, thank you, Michael. Allow me to invite Peter Randall, the CEO of Equiduct, to also join on stage. And while he's doing, ladies and gentlemen, let me encourage you to read this excellent Equinix magazine, because in there I think there's also pieces from Deutsche Börse Group as well as Equiduct. And Peter, just as you're coming, maybe Michael's last comment is a nice segue into multi-market surveillance post-MiFID. Peter, do you have a comment? Thank you.
Is this, yeah, it works, it works. Ladies and gentlemen, and Robert, thank you. Thank you so much. I feel a little bit up here like, you know, if this all does go badly wrong, Robert, you've got a great career in daytime TV. Your enthusiasm and complexity of the questions is wonderful. I also feel, frankly, ladies and gentlemen, it's a bit like being up here. It's a bit like disagreeing with my wife. I might disagree with her, I might be right, but she wins. And in a sense, I sort of feel that, you know, I might disagree with what the EC wants to do, and I might disagree quite for good reasons, but in the end, they'll win. So everything I have to say is put into the mix from an intellectual or an academic point of view, rather than from a sort of trying to kick somebody point of view. I would say, and I'll come to the question directly, Robert. I would say that MiFID II massively adds to the complexity that we have to deal with. Massively. I don't think that that's a good thing. I think that MiFID II absolutely categorically states, in writing almost, that MiFID I didn't work as well as it should have done, and that people haven't implemented the things that were there in MiFID I, so what we're going to do now is just go back and try and rehash the same old story in MiFID II. But you know what the really scary one is? Do you know what MiFID II means? It means MiFID III. And that means MiFID IV. The idea that we can regulate and regulate and regulate is going to do to our markets something which I think will have very deleterious effects to us as citizens in the future. I think certainly it's really important to go with the point that that's been made about collecting data. I think data is really, really, really significant here. And I agree that transparency is really very important. But you know what? I think one of the questions that we fail to ask ourselves so often is exactly what are the costs of transparency? Why do principles and why do business arrangements evolve to deal with complex problems that have different prices attached to them? And the reason for that, in all my experience, is because dealing with those complex problems in a private way is often a very good way of being able to give effect to the rightful demands of customers and the rightful needs of other participants within the financial system. To keep, if you will, with the airline analysis, though, which Seth so brilliantly expounded this morning, to keep with that, and to really bring that into very sharp focus, I think, with MiFID II, and to pick up that story about data, and I think this is the really critical piece. To me, MiFID II has missed an enormous, enormous, enormous opportunity. And the opportunity is all around cross-platform surveillance. Consider, if you will, at the moment, that there is only one air traffic control authority across the whole of Europe. As I understand it, happens to be based in the UK, but that doesn't matter. It could be based any place. But the point is that every flight that takes off anywhere in Europe and lands anywhere in Europe is controlled from one place. Each of the towers controls the traffic around their individual airport hubs, but the responsibility for making sure that flights between the hubs are safe resides in one place. Imagine the complexity if everybody tried to control everybody else. And the problem that one of the biggest problems that we've got in a fragmented world is that if I was a rascal and I happen to have a fairly sophisticated money laundering operation, I would quite easily find myself a broker that would trade one side of the bargain on one exchange, would unwind some on an MTF, would unwind some other in a dark pool, and would be money laundering to the gentry. It would be fabulously well organized, and I'd make an enormous amount of money. Why? Because each one of those individual platforms is responsible for seeing a trade come in from probably a very kosher, a very, very reliable and famous brokerage company. They would see those things come in. Everything looks completely straightforward. But of course, actually, it's only when you can see the big picture, when you can see that the unwind was done against another trade and the underlying client details were all the same, that you then begin to realize that actually across Europe at the moment, we've effectively getting very, very close to establishing a charter for money launderers and ne'er-do-wells. And that's something which I think is a totally unintended consequence. Because without having a cross-platform market surveillance system, we're really opening ourselves up to an enormous amount of potential harm. And I think that the other side of that is the very useful, very interesting, and very important piece around the consolidated tape. Sure, those of you who know me, but those of you who've thought about this, and those of you who participate in fixed protocol meetings, which I would urge anybody who's not a member here to join. But those people who are up to speed with it recognize that there's been an enormous amount of work done around making sure that the tape is consolidatable, important, and I think that work has now been completed. But the most important thing, and again, something massively missed in MiFID II, is to make sure that once you've got a consolidated tape, my business actually has one, it's available, it's tradable, but when you've actually got that consolidated tape, it's up to the regulators to enforce consolidation, to enforce best execution. And what's happened in the MiFID II best execution? Well, it was, I'm told, 427 words long, the definition. It's now 666 words long. So an enormous amount of additional complexity has been added to it. Ladies and gentlemen, I believe we've really got to get into understanding where we are with respect to cross-border surveillance. I believe that MiFID II has effectively missed a big trick in it, but I believe it's really, really important that the requirements in MiFID I around best execution, around the things that we're all familiar with, are properly implemented. Robert.
Thank you, Peter, for your provocative insights as always. Steve Leegood, let me invite you to the stage, and while you're doing that, Valerie, allow me to redirect the question to you. Clearly, as an authority, have you completely missed out about cross-market surveillance? Is there no protection against money laundering in Europe?
So I will answer the 3 points. The first point you want me to answer is cross-market surveillance. I fully agree there is a need to strengthen cross-market surveillance, and that's what we are doing with MiFID II, and we do it in the most cost-efficient way we could do. So that's true that cross-market supervision is the competence of national competent authorities because they have authority over national members, national investment firms. But we want these competent authorities to have access to the necessary information for them to detect and sanction market abuse. This means that we will harmonize and extend transaction reporting requirements, and we will also introduce record-keeping obligation for order books and order data for investment firms as well. And the cross-market supervision is under the responsibility of the home national competent authorities. I would say they will have the necessary information to have a consolidated view of the trading activity in the instruments that are under their surveillance, their responsibility, both in terms of transaction data and order book data. And ESMA in that field will have an important role to play also to help with the exchange of information and coordination between national competent authorities. That's not something new for ESMA neither, because the predecessor of ESMA, CSAR, was already putting in place what they call the transaction reporting exchange mechanism, the TREM database, to exchange the transaction data of instruments covered under the transaction reporting obligation. And I think personally, and I think I can say that we would back any proposal which would go beyond this initiative to reinforce cross-market surveillance, but we have also to balance the cost and benefits of any solution. That's for cross-market surveillance. In terms of the complexity of MiFID II, I think, yes, that's true that the OTF category might add a new type of trading venue, but I think that maybe in the short term there might be the emergence of new trading venues, but there is only a limited number of liquidity pools that can be sustainable in the medium to long term. So you might have like a wave of new trading venues, but then a reaggregation of different liquidity pools at a later stage. And then we really want also to overcome, to put in place the necessary tools to overcome the difficulties linked to the fragmentation of these markets and the complexity of these markets. That's why we have all these transparency rules and consolidation of data. And transparency, I don't think that it's fair to say that the best way to deal with complex problems is in a private way, because we have to look at the public good as well, and at a public and efficient price formation mechanism is a public good, and everyone has an interest in an efficient price formation mechanism, but when you look at your personal interest, individual interest, of course you might be tempted to stay in the dark or in a non-transparent environment, but we have to balance this interest. So that's why we have this this focus on trade transparency. In terms of best execution, I don't think we add to the complexity of the existing system. We have maybe, you think that the provisions on best execution have been lengthened, but what we have added is increased transparency both for trading venues and investment firms on how they implement best execution obligations so that it's easier to enforce.
Well, thank you, Valerie. Steve, you have arrived just at the right time. And ladies and gentlemen, if you are attending this event, on the website you will have a username and password that will give you access to additional materials. And Steve, I believe you also have a paper on the website. Tell us also your insights around some of this multi-market surveillance. Thank you.
I certainly will. Although, actually, I think Peter has said much of what I wanted to say. So that means that my job is really to amplify some of the points. I guess I'll start with the airplane analogy. Seth mentioned that how miraculous it was that he travels from Anchorage to Istanbul and his bags arrive at roughly the same time. That's an important characteristic of a series of plane journeys. For me, it's much more important that the planes don't fall out of the sky. And the same thing is true for the markets. If it really is a charter for rascals and ne'er-do-wells, that's not in anybody's interest. It's not in the interests of the real economy. And one of the drivers behind MiFID and MiFID II, yes, MiFID II is about patching MiFID I, but the drivers behind it, one of them is that the markets as a whole should work for the benefit of the real economy, for investors and for companies. Another driver is to reflect the intention of the G20 to make sure that the markets operate without undue risk. And all of these things come together in do the markets actually have integrity? Well, I don't think they do. I think we do have a charter for rascals and ne'er-do-wells. The European Commission's own estimates of the scale of the lack of integrity in markets in the impact assessment that goes with the market abuse paper proposals estimates in 2010 in EU equity markets alone that market abuse had a cost to the real economy of 13.3 billion euros. Well, that's just equity markets, and that's just the EU. You scale that up to the whole world, you scale that up to other asset classes, you're into the hundreds of billions. And that's before you've even thought about cross-market abuse. That's simply, their estimate is on market-by-market abuse. Cross-market abuse is much more attractive if you're a rascal or a ne'er-do-well. Exactly as Peter says, that if I wanted to do front running, for instance, you have to be pretty foolish to do that all in one market. Even if I was doing it on multiple markets, I'd probably be pretty foolish to do it in just the equity. Why wouldn't I also do it in the equity derivatives to cover my tracks? So it is a serious problem. If we scale that up to hundreds of billions globally, that's the same kind of scale as the global illegal drugs trade. And that is a problem that the world takes fairly seriously. So I'm kind of a little curious why the world doesn't take this problem here a little more seriously. I do think that MiFID II and market abuse directives, ESMA and its guidelines, it's taking a kind of a stricter approach to the issue than CESA did. So I think that there's a number of good things which are happening. But I really fear it's not enough. The temptation for rascals and ne'er-do-wells is still there. They have motive, means, and we have not removed the opportunity. MiFID II does not remove the opportunity. partly for organizational reasons. Who does have the single pair of eyes that would be able to surveil everything? Structurally speaking, no one does. Yes, it's good that national jurisdictions will get better data. Transaction reports is, of course, not enough, and it's good to hear that they'll be getting order books too. Better late than never, I might say. That's all good, but I've been doing some research with my colleagues looking at misbehavior, if you like, or anomalous behavior in the markets across Europe. And if you look across the markets, it's pretty salutary what you can see if you look. But I can also demonstrate that I can see things doing that no one regulator anywhere in the EU, or indeed anywhere in Europe, is able to see, because no one can see everything. So somebody needs to be able to look at everything.
So Steve, thank you for that. Just a follow-on question. Does your organization have any proposals about how to address it? I think Valerie was very open to invite proposals from the industry. Do you have a solution as it is today, or do you also need some help from the authorities to put in a framework to provide a solution?
Well, part of my answer to that would be, why do we need input from authorities at all? This is an issue that, as an industry, that we have bad apples in the industry, and surely it's in the industry's interest, if only for self-lightened interest, but actually for good commercial reasons. We heard from the gentleman this morning, the economic hitman, that we should be doing business for ethical reasons and protecting the society as a whole and society in the future. If we believe that, and if there's anybody in the room who doesn't believe that, then I'll talk to you in the bar afterwards maybe. But let's assume we all believe that, then how come the industry doesn't get its own house in order without needing thousands of pages of regulations and directives and instructions and sanctions and so forth? Surely it's in the interest of the industry for all sorts of reasons, commercial, ethical, being able to sleep at night kind of reasons, to deal with the issue. So the second part of the answer then is how could the industry organize itself to deal with the question? And I think maybe the history from Germany, where the surveillance activities, the regulation activities, were separated from the operational activities, still run by the industry itself, but more in the kind of for the public benefit rather than the benefit of the operation. So that's maybe one model I think is pretty good. I do think there are some technical issues. And I can get really quite excited about that. I mean, I've spent most of my life doing such things. But I don't think that's the main part of the solution. The main part of the solution is an organizational one, being clear about what the issue is, clear about what needs to be done about it, clear about where responsibilities lie, and try and move from this kind of the mode we're in at the moment, where I think there's quite a lot of shoulder shrugging or slope shoulders about the issue, so that kind of every individual organization knows it's got to do surveillance or compliance or be a regulator, but it kind of does the least it needs to do to get the right ticks in the boxes, as opposed to properly addressing the issue. Part of that is it's on the cost side of the business plan. I feel that there is a model, a commercial model, that can put it on the revenue side, on the business opportunity side. When the race to the bottom is run on tariffs and latency and so forth, given all other things being equal, where would you rather trade? On a venue which can demonstrate that it has integrity, or take a risk on one that can't?
Well, thank you, Steve. By the way, ladies and gentlemen, we do have the privilege of Anneke van Hartman, the head of surveillance of NASDAQ OMX, will share a few of these case studies in the panel that's after the break. But let me come back, Michael, to you in Germany in terms of the case study. I think Deutsche Börse has shown very positively, as has London Stock Exchange and NYSE Euronext, in a few of the very high-profile cases of things like spoofing and layering. Once it became aware, those of us in the market probably raising their hands, because when there is less market integrity, the natural populace of those that like integrity, it's a check and balance to raise it to the exchange and the supervisory departments, and you responded very quickly. What is your insight? I think Steve raised a good point, that in Germany, fragmented, you had a separate framework. Does it work well, and should there be something that we should learn for the rest of Europe? Thank you.
Yeah, Thank you for the question. I think definitely in Germany, the integrated surveillance with the different surveillance offices of the different exchanges work perfectly fine because they have full oversight of the data that is traded on the different exchanges. I think so. What has been mentioned, that the consolidation of data and the trading surveillance office being able to access the data is a very important point to really keep the market integrity at a level that our market participants want to trade and want to create trust on trading on our trading venue. I believe the model that worked in Germany so far could be something that could be extended also on a European basis, because as I've mentioned, the different setup of the public law and the private law part is something I believe creates a lot of trust with the trading surveillance office not being related directly to the business part of an exchange. So I believe that that clearly is a good anchor to really run markets smoothly. In the incidents that you've just quoted, of course, our market surveillance office was checking on different spoofing and layering strategies within the market. But guess what they found out? Certain market participants ending up in mainland China, trading via X, Y, Z brokers, ending up in our trading system, created certain trading strategies that were not allowed in our law. But of course, getting then these guys from mainland China and restricting them from trading is a hard job and takes sometimes a little time. But I think as of today, we've managed to really exclude these from trading, these strategies, by just keeping on track with the process chain of the order flow that was sent out of China via, I think it was 5 brokers to our trading platform.
Well, Michael, thank you. Peter, I'm going to come to you in just a minute. First, ladies and gentlemen, opening up for questions. Question at the front, Michelle Price, Financial News.
Hello. Valerie, I'd be interested to get your view. So, regarding the negotiations on the Market Abuse Directive, I understand that there are some people on the left of the Parliament who are pushing for ESMA to have sort of direct cross-border supervisory control, and so to be this entity that would be the all-seeing eye. Now, my suspicion is that Arlene McCarthy is not in favour of that, who is the Chief Rapporteur. From the Commission's point of view, do you think there is a stronger role for ESMA? I mean, you referred to ESMA as, helping facilitate the exchange of information, but then you sort of said, well, CSER already did that anyway. What is the role of ESMA in this debate?
I mean, the negotiations are ongoing, so I hope we will soon see the report of the European Parliament, so we will see in which direction it goes. And then the Commission will have to decide whether, it wants to support or not certain proposals. So I will speak just personally. Personally, I mean, it makes sense not to support any reinforcement of ESMA role in terms of cross-market surveillance. And what we've done goes into that direction, but that's true that we could go even beyond with a kind of, centralized order book database at the level of ESMA, to which national regulators would have access or things like that. So we will see what the outcome of the Commission of the negotiations are, but at least there is a political willingness across the board, both at the Council, at Parliament, and within the Commission, to reinforce this cross-market surveillance and to really deter people and to commit market abuse and to sanction to catch these people if they do.
Thank you. Another question from the audience. 2 questions, one in the middle, one at the back.
Thank you. Actually, I think Peter's quite right. You do have a job in daytime TV if everything collapses, Robert. I'd like to know from the panel how much of this is actually driven by the political view right the way throughout Europe, rather than market. All these changes. Peter?
Great question.
Actually, sir, and I'm going to just add on a comment to that just to be provocative as the moderator. So, Peter, you've had a remarkable role as chief executive of Chi-X Europe, which became the biggest new entrant and overall entrant in Europe. You are now the chief executive of Equiduct, which I think is it still related to Börse Berlin in Germany? And my humble question is, are there not natural checks and balances in the market that if the clients, the end investors, feel they are not getting a better result, all go back to the incumbent exchanges, which can show the quality of the flow, a broader spectrum, good, robust surveillance? Isn't there a natural check and balance in the market? And thank you for that question, Simon.
I think to they're this sort of multifacets of really the same sort of answer. I think certainly in terms of commercial pressure on institutions which previously acted as rapacious monopolies. We think prior to 2007, the customer service levels at the majority of exchanges, the pricing at the majority of exchanges, the technology at the majority of exchanges. Today, it's radically different. Prices are lower, trading volumes, particularly today, are off a bit, but generally, prices are lower. Surveillance, I think, is better. Technology is streets ahead. The regulatory environment is more certain. I think that's a very, very good thing. To Simon's point about, is it driven by politics? Well, I guess to a certain extent it's all driven by politics. But I would want to back up a little bit, ladies and gentlemen, to a point of view which is probably deeply unpopular, but I think it's actually very, very realistic. If you look at the population shape of Europe over the next 20 years, if you look at Germany, you look at France, you look at the UK, you look at Italy, we are massively aging populations, massively aging. The net effects of that are that the social contract as between governments on the one hand and the people on the other hand is unlikely to be supported at the current levels. Governments simply cannot afford to make the healthcare promises, the educational promises, and the welfare and pension promises that they made in the past. Therefore, the implications have got to be that the individual, you and me, my mum, your mum, everybody's mum, has got to start to make those choices for themselves. Those choices for themselves effectively, and I'm going to use the lingo because it makes sense, because everybody understands what it means, but effectively what that creates is that there is a dire need for something like a 401k plan in Europe. Something that has tax benefits, something that allows people to save for their own retirement, to make their own healthcare decisions, etc., etc., etc. But those things to be successful will need to have clear, open, transparent, and dedicated markets. I don't think we're there yet. I think we've gone a very long way towards it with MiFID I, but I don't think we're there yet. And I think one of the biggest problems is this cross-border surveillance. Now, I'll go one stage further, if I may, than Michael's example, although I do agree that the sense of Michael's example is absolutely correct. This is something on cross-border terms that needs to be provided by a body that is independent from the incumbent exchanges. I cannot imagine that any exchange would want to give its customer data, its trading data, its order book shape, and all the rest of the data in real time to any other exchange. I just can't believe it would happen. I would put then a very, very provocative case that, well, if that is the case, then maybe everybody should give their data to Chi-X, because that's the biggest. So it makes more sense to give it to Chi-X than it does to NYSE Euronext or Deutsche Börse or the LSE. Well, that's obviously not going to happen. No, I think the body that looks after this needs to be independent, funded probably by some very, very tiny levy on transactions, but absolutely dedicated to being best of its breed in terms of market surveillance and digging out the rascals and the ne'er-do-wells.
Peter, I'm just in the moments of time because we want to go on to
Sorry.
the next panel. Hold on. Is there another question there? 2 more questions. Thank you. Thank you, Peter.
It's Alan Green from iShares. It's probably quite a specific question aimed at Valerie. We know that MiFID II will include ETFs as an eligible security and that all OTC trades will have to be reported. But I just wanted to focus on a slide that Robert put up earlier about the OTC flows against the exchange-traded flows. Obviously, as an industry, we're sort of focused on growing our exchange-traded flows. As that's quite a key, unique differentiator of exchange-traded funds over other products. I just wondered what sort of measures the commissions were potentially, or any thoughts that the commission would have on how we go about this and whether they're looking at any legislation to require it.
I'm not sure I completely got your question. So what you mean with, what are you looking for in terms of regulatory intervention on
whether there was a view on encouraging exchange-traded flows, which are mostly OTC at the moment. Yes, they will have to be reported under MiFID II, but what the view on the Commission was to encourage those flows back onto a regulated, highly regulated exchange.
I'm sorry, I heard exchange-traded funds, so I was a bit confused. In fact, what we are doing is, under MiFID II, it's the same philosophy as MiFID I. We are agnostic in terms of where the trading takes place. But what we want to do is to apply the same rules to the same activity. So it means that all multilateral trading activity will have to take place on either regulated markets and MTFs or OTFs.
Sorry, but Valerie, I think actually your question, sir, was about ETFs, exchange-traded funds. And Valerie, just correct us. Is it true that today the share MiFID list in Europe today does not include ETFs in the MiFID list? Funds are generally outside of MiFID at the moment. Is that correct?
No, because UCITS, for example, are in. Funds are in. So I'm not sure but maybe we can discuss this bilaterally afterwards because I'm not sure I got your point.
All right, we'll park that question for the next one. But I think the key insight is that exchange-traded funds outside of America mostly trade over the counter. I think that's your comment. And there may be an opportunity to see more of the on-order book, on-exchange trading those products. Was that your question, sir? Thank you. All right, we'll follow up on that later. But thank you, Valerie. Thank you for that excellent question. Another question at the back, and then we'll come to Deutsche Bank in the front. Thank you.
Hello, Adam Eads from BATS Chi-X Europe. I just wanted to pick up on the point that Peter raised and agree with that. I mean, to a large extent, BATS Chi-X is in fact looking at markets across Europe currently. So we are cross-border, surveilling the markets that we trade. And we also, where possible, try and take reference data from other exchanges as well. And we have therefore been able to refer a number of incidents to regulators across Europe, not just in the UK.
Thank you, sir. Was that a question or a supportive comment?
No, it was a supportive comment about what we're trying to do at BATS Chi-X Europe to look at Europe as a whole.
Thank you very much, sir. Right at the front, Stephen McGoldrick, please. Thank you.
Thank you very much. Stephen McGoldrick from Deutsche Bank. This is a question for all of the panel, because I think Valerie's been picked on quite enough already. But it is drawing on some of the comments that she has made, particularly starting from her comment that there's a stick behind the door, that if the industry doesn't deliver a consolidated tape that works, then in 2 years' time there'll be a review and there'll be initiated a project to implement one. This is in a context where the Buy-Side Trade Association of Pharma has published a document outlining what they would like to see from a consolidated tape. And they've asked the regulators to deliver a single tape provided by a single supplier, but to preserve competition by rotating that supplier, or at least putting it up for rotation periodically. Pulling it together with the topic of monitoring across venues, one of the proposals within the PhAMA paper is that you use the privileged position of the single provider to handle enriched data and to create a central pool of data that can be useful to regulators because it's enriched with the counterparty details. in the backdrop where we're talking about putting tariffs onto trades to make this happen, there's an opportunity to get it for free and to deliver to the representatives of the pension funds and the pension fund holders what they want in terms of a consolidated tape. So why would you wait another 2 years after implementation and another couple of years after that? We could easily be talking 2020 to solve a problem that was identified in 2007. I'd like to know what the panel think on that.
Thank you, Stephen. Michael, would you like to take a view as an incumbent exchange? Thank you.
Yes, of course. Thank you for the question. I believe the real problem regarding data consolidation is truly the inclusion of the OTC data that is not really available as of today. So, as from my perspective and understanding, I believe that the Commission is asking for 2 more years because they are not trying to include all the OTC data in the data that is available for different vendors. So I fully support the decentralized market-driven solution, and I think we all need to sit together to really address the issue of the post-trade data that today is not perfect, as we all know, and give it another 2 years to then deliver something that is required in the industry.
If I may just, because that's not the first time I heard this comment, is what we mean with a consolidated tape is trade data from all 3 categories of venues and OTC trades also via the approved publication arrangement. So it's really a complete EU picture, trading data picture.
Thank you. Peter.
Yeah, thank you, Robert. I mean, I think the answer, Stephen, as you're very well aware, is that actually what you're doing here is stepping on some fantastically powerful vested interests. We produce at Equiduct something called market by limit. We do it regularly. It turns out it's executable. You can trade against it. It works. Bloomberg, they won't take it. Reuters won't take it. People won't distribute it. Why not? Because Bloomberg have got a product that they do. It's not executable. It's not as good. It's not out there. It's not seen as being useful. Reuters won't take it. Why not? Because Reuters won't be able to execute against it. Reuters won't be able to collect money against it. The point is that they're just 2 of the roadblocks. The other roadblocks are the major exchanges. The major exchanges are rewriting at a pace unbelievable to anybody that looked at how they were able to rewrite things even 5 years ago. They're writing things at lightning speed, at warp speed, to change their black box agreements, their market non-displayed agreements. All these things are changing all the time. And what's it all about? It's all about protecting the revenue source that they get from market data. I happen to believe, and people have heard me say this many times before, but I happen to believe that a business model that requires you to go into a shop and go to the shopkeeper and say, I'd like to buy a litre of milk. And he says, well, that's very interesting, sir. But first of all, before you do that, you're going to have to buy the price list. Well, that's what happens when you go to an exchange. Before you can actually trade, you've got to buy the price list, right? Then you've done the trade and you say, well, I'd like a receipt. Ha ha, yes, sir. You could have a receipt. You've just bought the data, so that's fine. So you know what the price is. But you want to know how much you paid for it? You've got to buy a receipt as well. It's a great business model, right? You sell them the price list, you sell them the stock, and then you sell them the receipt. And then you organize politically, you organize the relationships with your data vendors, you organize the relationship with the technology providers to prevent any competition in that. This is an enormous industry, and that's why it's so difficult for the folk at the European Commission to implement anything like a consolidated tape. Take the money out of it, make it available as a public good for everybody, and we will see a massive blossoming in innovation, which is going to be vitally important to Europe to grow its way out of this mess. We'll see a massive increase, I would believe, in new ways of thinking about how to trade, and we'll see a massive improvement in general market quality because people will know what's going on. Best execution is where it's all about.
Peter, thank you for that. Steve, I'm going to bring you in But first, I'm going to let Michael respond to that comment. And then please.
Thank you, Peter, for that interesting information you just spread, which is only partly true, at least for Deutsche Börse, because we are not selling the price list to our trading members because they get all the data for free on our exchange, so you don't have to buy the price list to become a trading member on our exchange. And of course, we believe that the data that we are producing on our trading platforms, being the reference market, have another value than the prices that are generated on other venues that just copy the price out of our order book. So I believe there is still value in the data that we are producing and disseminating. Thank you.
Thank you, Michael. Steve?
I just want to quickly pick up the second part of your question, really, which is why wait another 2 years and then another 2 years after that? I mean, that's absolutely spot on. Ever since I've been coming to this conference and one's like it, there's the topic of the consolidated tape, and preferably a hittable one, has come up every single time. But I would make the same comment earlier on. Well, why does it need these guys to tell the industry what to do? Why doesn't the industry just sort it out?
Thank you very much. Thank you. Another question. Ladies and gentlemen, I think we've had a full and dynamic panel. I want to thank all of the panel members for being very candid and contributing in the spirit of partnership. Thank you very much. Thank you.